give a definition of business ethics, simply the study of the morality of business. And we look at what we consider to be right or wrong behavior in business activity. We have three prongs. We have what's called descriptive ethics, where we simply describe what's going on in the business world. Their relationships with customers, their relationship with employees in the workplace, relationship with larger society. Then we have what's called meta-ethics, the second prong, which is more an evaluation of what is in fact going on. And through that meta-ethic lens, we come to what the final prong is, normative ethics. Is that action or policy, behavior, right or wrong? Do we view it through those principles as a correct behavior or an incorrect behavior? And then also, hopefully coming to alternatives or suggestions or even improvements. If it's right in one sense, maybe it can be enhanced or improved. So it's that combination of descriptive ethics, meta-ethics, and normative ethics. The three together give us what we consider to be business ethics. Another period, a more recent development in business ethics is often referred to as the post-Enron period. And with the scandals of Enron, Tyco, WorldCom, there has been created great mistrust in companies' financial documents because executives, auditors were misleading, sometimes subtly, sometimes extremely, the wealth, the well-being, the viability of the organization. In the Enron case, the most egregious example is they had separate businesses. What they were doing is all their losses, all their debts were being siphoned into this separate organization and not showing up on Enron's balance sheet, not showing up on Enron's income statement. And so people thought, oh, the company's doing well, when in fact it was not. And what arrived after that is this concern and this need, this responsibility, in fact, this great duty. You have to be held more accountable. You need to be more transparent with your financial documents to the public, especially to investors. And what was created is what's called Sarbanes-Oxley. A new law was created to implement those values underlying it, about this accountability, about this transparency. Sarbanes-Oxley has three prongs. One is that accountability of executives. The chief executive officer, the chief financial officers, actually they have to sign off on the financial documents and say, yes, these are accurate to the best of our ability. And if they are not, if it is proven that if they can show that they are not accurate and they should have known that they were inaccurate, they can be held both civilly and criminally responsible, meaning they can end up in jail. The second prong is auditors who were supposed to be independent. All the public accounting firms, in one sense, are auditors. Now the government has created an organization to watch over them. And the last prong is to make sure that there are internal controls that oversees the board of directors. They, in fact, look and make sure that the board of directors have a degree of independence. And the auditing committee is independent of the board of directors. No board member is allowed to be on that committee. And someone definitely has to have financial expertise. You also need a code of ethics. You also need procedures. And that's part of the controls to make sure that what's recorded, what's reported is in fact accurate.